Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so we're going to talk about the economy, the projected potential recession, and the housing market, and how this all is rolled up into the same thing.
Okay, so in the comments, give us real quick your little quips about the economy. Bill Clinton's favorite phrase was, "It's the economy, stupid," right? So that's one of the favorite quips about the economy. So put in the comments your favorite quips about the economy and who made them famous.
Okay, also put in the comments if you think there's going to be a recession in the next 12 months, yes or no, and if so, how long it'll last. 3 months, 5 months.
And take out your crystal ball and tell us which quarter do you think it's going to start in.
Okay.
So lots of things. You have homework. Come on, get going.
Okay, so we was a couple articles that we went through. This one says economists boost U.S. growth projections, reduce recession odds. This is because new Federal Reserve data came out that showed the economy doing much better than the Fed thought it was doing.
Right.
And even Jerome Powell came out and said, hey, the economy's doing really good, but we're watching it.
Right. So remember, the Fed kind of got caught flat-footed at the beginning of this, and so now they're very cautious, which is a good thing for all of us, right? It's a good thing for them to be cautious, to watch the numbers, and make choices wisely rather than impulsively.
All right, so here's the thing from Bloomberg. Economists raised their U.S. growth projection through early 2024 and trimmed recession odds to a one-year low as consumers continue to spend. So remember, we've been, for the last 2 years, we've been going through the chance of recession. And remember, over a year ago, it was 100%. It was, there's going to be one. Everyone says there's going to be one. And then the 100% started dropping. And this was 74 economists or something were polled. They polled a bunch of economists, okay? All right. The economy probably expanded at an annualized 3.5% rate in the third quarter, the fastest in nearly 2 years, as forecasters mark up their household spending forecasts. And while growth has seemed slowing in the following 2 quarters, economists in the latest Bloomberg monthly survey still marked up their estimates for GDP. So they haven't, everyone's sort of trying to track the data. And the economy, saying the economy grew at 3.5% average, which is smoking hot. That's a hot economy.
Right.
So remember, the third quarter just ended. So for the people like, we're in the recession, can't you see it? It's happening right now. We're watching it in real time. Well, when the GDP numbers come out and say the economy grew, that doesn't mean we're in a recession, right? What's the definition of a recession?
2 consecutive quarters of negative growth.
Negative growth. So you have to have negative growth. A slowing, if the economy's growing, if it grows at 3.5% one year, and the next year it grows at 1%, it's still growing. That's not a recession. It's just growing slower. It has a recession. The economy, the value of the goods and services produced has to actually decline.
Right.
All right. Okay. A still robust labor market continues to support household spending despite the burden of high borrowing costs and inflation. Employment projections for the next year were revised higher, helping explain why economists now see even odds of a recession next year. So employment projections, meaning more people employed, which means less unemployment, more jobs being created. And when you have jobs being created, that usually means companies are expanding. And if they're expanding and growing in aggregate, now, it doesn't mean some companies will certainly shrink. Ron, did you remember a year and a half ago, all these tech companies were laying off people?
I do.
And they were like, Todd, this is you're seeing the recession happen. All these job losses, these are the recession. And then the GDP numbers came out, the economy grew at 2%.
Right.
So yes, they focused on job cuts, but then all the other companies were growing. Nobody really focused on those, right? Okay, now this is what's really cool. So this is a chart. Now, in the chart, they have the September surveys. They survey all these economists and say, what do you see GDP doing per quarter? Now, this is an annualized growth rate. So if it says 3%, that means it didn't grow 3% in the quarter. It grew at an annual rate of 3%. Okay, so basically grew at 0.75%. And then in the fourth quarter, it's going to slow. We're in the fourth quarter now to 0.5%. And then 0.1 in the first quarter, which is first quarter, second quarter, when most of the economists are saying that the economy is going to slow because they're watching the trajectory of change, and they're trying to forecast when this thing is going to, stop growing. But then then they're all saying, oh, by second quarter, third quarter, it'll start growing again. Remember, this is aggregate. So there are people who have worse, right? There are some economists, Juana, who said, oh, nope, fourth quarter is going to start. It's going to be really bad in the first quarter, maybe break even in the second quarter, and then in third quarter, it'll start growing. So this is just the thing. What's interesting is the next month, the October survey, is much better.
Right.
So they surveyed in October and said, now tell me about these 5 quarters or 6 quarters. And the numbers basically improved for the most part.
Right. So, what's interesting to note is, remember, first quarter tends to be slow on the consumer end, right? Because everybody spent their money in the fourth quarter on Christmas or whatever. And so the first quarter tends to be slow anyway. So that's kind of part of what's in there. So it's a little bit disingenuous to say, oh, it'll be first and second quarter. Well, first and second quarter are generally slow anyway. So it is possible that we'll see a pullback in the first quarter. I think that's probably the largest chance of that. I think that if we get through the first quarter and the first quarter is a push, I think we're fine the second quarter. The other thing to keep in mind is next year is an election year, so there's going to be a lot of variables in play, right? It's going to depend so much on consumer sentiment, and consumer sentiment is going to be all over the map depending on what's happening. So it's going to be kind of a volatile year. We're not going to know if we're coming or going, which is pretty typical for an election year.
Okay, how does this affect housing? Let's say we have a recession. The crash bros and doomers are all thinking that, and their sycophants, are all thinking that the second the job losses happen, there'll be massive, like literally within hours, the massive foreclosures will start. Because you will stop making your $1,100 a month mortgage payment because you can't afford that. You'll have to go pay $2,000 a month rent because you cannot afford $1,100 a month mortgage payment. Even though your spouse may still be employed, you lost your job.
Right. So short answer, no.
Okay.
Longer answer, look, it takes upwards of over 3 years to get from missed payment to foreclosure. So the chances of that are actually very small. People are smarter than that. Okay, yes, I mean that. People are smarter than that. People make smarter choices. People understand that $1,100 a month mortgage payment is preferable to a greater rent payment. People understand that they have equity, so if they are in a position where they need to sell, they will go ahead and sell, and they will pocket the equity. So people are smarter than that. As far as the crash bros are concerned, I'm kind of done talking about them. I've lost interest, I'll put it that way.
What happens normally is if the economy slows really bad, a recession, what does the Fed tend to do?
So the Fed tends to cut rates. I think the Fed is not going to be very fast on that this time around. So even if we have a mild recession, I don't think the Fed's going to cut rates. I think the Fed's going to stay put. I think the economy would have to really give signals that there's a whole lot worse in the future for the Fed to consider cutting rates for any meaningful amount. I mean, could they cut a quarter point? Sure, but is that a meaningful amount when rates are when mortgage rates are 8% and the Fed cuts rates a quarter point? Big deal. That doesn't move the needle. As far as housing is concerned, housing is not going to be really affected by any of this because it's not going to change inventory levels. So long as inventory levels stay really low, it's not going to really matter as far as housing is concerned. I mean, will a few more houses come on the market? Okay, fine. But right now we are selling more houses than the number of houses coming on the market. We have more buyers than we have sellers. So long as we're in this position, home values are going to either stay the same or continue to increase. Now, does this speak to everybody across the country? Of course not. Real estate is hyperlocal, and everybody's market is anywhere from a little different to substantially different. But when we're looking at the nation as a whole, that's what we're expecting. We're expecting home values to either stay the same or increase modestly. And I mean that modestly. I'm not expecting home prices to take off until rates moderate. And rates are not going to moderate anytime soon. I think the soonest that I would envision rates moderating would be maybe second quarter of next year.
The next thing is the percentage, the guesses that they had. So economists think odds of a recession in the next year have fallen below 50%. This is a separate article. Wall Street Journal survey showed the consensus probability of a downturn in the next year dipped below 50% for the first time since mid-2022. Now remember, last year at this time, there was somebody who came out with a 100% chance. They said there is a 100% chance there will be a recession in the next 12 months. It was 100%. Remember,
there are only two things that are 100%: death and taxes. Okay, those are the only things that are 100%. Everything else, not so much.
Okay, and here's the cool part. So this is the chart. So if you go back to March of 22, there was like a 20-something% chance. And then you can see the little solid lines. That is the Goldman Sachs. Okay, that dark blue line is Goldman Sachs estimate. Okay, now Goldman Sachs estimate, the highest it got was like close to 40%. And then the Wall Street Journal consensus, they poll a bunch of people. It's a consensus. So they're asking a bunch of people. And then you can see here the different things that happened. Rates were raised, yada, yada, yada. But what's interesting was the consensus is now below 50%. And it hasn't been below 50% since probably August of last year. So the consensus for most of the last year was like 60% chance. But remember, guys, think about this. Go back to September 22 on this chart, that line. Goldman Sachs said there was like a 30-something, call it 35% chance there would be a recession. Well, there wasn't a recession, right? The consensus was 60% chance of recession. Well, there wasn't. So the 60% chance is more than half of half, and there wasn't one. So Goldman's, you could argue, well, even if there was a 99% chance, there's a 1% chance there's not. But they're more bullish about a recession than everybody else. And what's interesting is the downward trend. Now, I don't know, they could all be wrong, and there could be a recession starts in the fourth quarter if things get really bad or some external event that they can't predict. But, it seems like that like Wanda said, people aren't stupid. And if I'm having economic problems and I have a house that has equity and I'm making a super low mortgage payment, the last thing I want to do is upset that baby. Because why would I get rid of the payment to then, have to make a rent payment when I have a super low house payment? If anything, I would be like, I don't really care. And then the other thing is, the assumption is that first of all, there's a bunch of assumptions you have to make about job loss. One is you're sole income earner, and there's now no income. Even with that, you have to assume there's no savings. They didn't save a penny, and now they can't make that next payment because they're living paycheck to paycheck.
So the thing to keep in mind, remember when I said that foreclosures take over 3 years? How long do evictions take if you don't make that rent payment? I don't care where you are. Chances are that it takes less time to evict somebody for non-payment of rent than it does to throw somebody out of a house due to a foreclosure. So keep that in mind too. I mean, look, there are a lot of different things at play here. And again, I rely on people's common sense, that people are going to have sufficient common sense to understand that they will get another job. It will all sort itself out. They're smart enough to contact their loan servicer and say, hey, this is what's going on. Let's work something out until I get another job. There are all kinds of workouts that you can do. Not as much if you are paying rent, right? Because that landlord has mortgage payments to make, needs the money to live on, whatever, and that landlord needs the rent. So it is a different situation. I think people in a home generally are better off than tenants. I think they certainly have more protections. They have equity. They have a lot more tools at their disposal to deal with a life-changing event like a job loss.
Remember the pandemic? 4 million people stopped making their mortgage payments, were in default. 2 years later, 97% of them had resolved it. They'd either sold the house, they got a refi, they went to the bank, and the bank said, okay, we'll extend your loan another year, and you just start making payments next month, and we'll just tack all what's owed onto the back end, and you just make another, you missed 4 months of payments, but you just make a year of payments. But these people all resolved it. So my question is, where are all the foreclosures? That was literally that was a massive recession. We had, like in Vegas, we had 30-some-7% unemployment or something crazy.
Right.
It was a horrendous recession. The economy lost like 12% GDP growth. It was like negative 12%. It was like the worst recession we've had since the Great Depression, even though it was a very short period of time, because the economy basically shut down for a couple months, right? Where are all the foreclosures? Remember, that was 3 years ago. Where are they? Why didn't we see them? Why would you expect a minor recession to have a massive amount of foreclosures when the last massive recession didn't have any foreclosures? Like, that doesn't make any sense. And like Wanda said, even if we did, it takes 3 years to foreclose. Mm-hmm. You have to miss a bunch of payments, and the banks have to, they have things they have to do legally. They can't just immediately foreclose. And yes, if there were, then fine. In 3 years, there would be foreclosures. But in 3 years, the economy would be kicking butt, and all these people would be like, hey, economy's good. I got a job again. I want to make it up, and let's cancel the foreclosure.
Mm-hmm. Right.
Right.
All right. You got anything else?
No, that was it.
All right. How'd you like Todd's chart? I thought it was pretty cool.
I spent all night making this chart.
I liked it. Hope you liked it too. I hope you left us lots of real estate related comments and that you answered all those questions that we posed at the beginning of the video. Because we are interested in your comments. Please remember to like the video, subscribe, hit the notification bell, share the video. And if you need somebody to help you sell a house or buy a house in Las Vegas or anywhere in the country, please reach out to us and we'll be happy to help you. We'll see you on the next video. Bye.
Bye.